Okay, I think everybody should have heard that. I want to welcome everyone to the fifth in 8 webinars on succession planning and employee ownership. This session today is being presented by Tom Gilbride of Gilbride & Company. I've been working with Tom rather closely for the last year or two on succession planning issues. Tom's a good presenter. In addition to his consulting work, he also does continuing education and training programs in the state of Ohio. So if anyone needs to get their CE credits before the end of the year, Tom's one of the guys you can go to. Today's topic is going to be small business planning for multiple shareholders. And oftentimes we see in a lot of small businesses that with multiple shareholders, these succession planning issues can get all the more complicated. So we got Tom here to hopefully give us some hints on what to do when that situation arises. So I think without further ado, I'm going to turn it over to Tom.
Okay, thank you, Chris, and good morning, everyone. Let me take care of a couple of housekeeping items as we get started here. You should see on your screen the title page for the presentation. The next slide, course description. The material that you received in advance of this told you that this webinar includes a discussion or presentation on legal and financial protection for each shareholder in a multiple ownership scenario. In addition to that, it's planning for the exit of one or more shareholders from the business enterprise, planning for potential discord between shareholders. So in general, what we're going to be talking about are agreements that owners enter into to address the protection, exit, and discord issues that I just mentioned. So generally speaking, we call those agreements buy-sell agreements. They're basic contracts, and they take a number of different forms. So you can find the provisions for buy-sell in a separate contract entitled a buy-sell agreement, or these provisions can be built into other business agreements that shareholders often enter into as well, and I'll describe those momentarily. Next item, the use of the term partner throughout the presentation. Depending upon the type of business entity that is in question here or in play, the owners are called different things. If you own a stake in a corporation, of course, you're called a stockholder or a shareholder. If you're an owner of a limited liability company, you're referred to as a member, and if you're an owner in a partnership, you're called a partner. So just for simplicity's sake, I'll tend to use the word partner today to describe all of those people and just kind of keep it simple. Further, what we're going to talk about today are multiple ownership businesses. So multiple owners means privately held businesses with 2 or more owners. So it could be 2 people or a dozen people working together in ownership of a business. In these situations, the owners are typically also the operators of the business, but you certainly can find situations in the marketplace where some of the owners may be passive. They simply own a stake in the company, but they don't work there. Further, the owners are typically not related, but you again can find situations where people are in business with immediate and extended family, siblings, cousins, and so on and so forth. For purposes of this presentation, I'm simply going to limit my discussion to unrelated parties who are not are active in the business. So I won't really discuss any issues with regard to passive owners, nor will I discuss any issues in businesses where there's immediate or extended family involved in ownership. However, if you have questions on those kinds of things, certainly feel free to bring them up at the whenever you choose. Now, the next slide, the reality slide kind of introduces a series of slides where we talk about such conditions that actually exist in the marketplace. So when you go out there and you talk to small business owners where there's multiple ownership, these are the kind of things you tend to find. Usually, when business owners form a business, they decide to get into business to get together, there's some obvious things that occur to them. So the need for planning is more obvious, as it says, in a multiple ownership situation than it would be with a single owner or with a family-owned business. And unrelated parties often think about, or somebody brings this up in a conversation, what if my partner were to die suddenly? Who owns his or her interest in the business under those circumstances? What problems may arise, and could it hurt me, other partners, or the business itself? So again, that's kind of like the 800-pound gorilla in the room. These things are relatively obvious to these people, or if they're not, someone such as an advisor, an attorney, or a consultant brings it up, and the owners usually quickly agree that these are potential problems that could hurt the business or us. So they move to a conversation where they talk about entering into some form of agreement, and they typically do enter into some type of an agreement early in their, either at the formation of the business or early in their business ownership career. And what they often enter into, as I said earlier, is a contract. Often that contract is called a buy-sell agreement. So at the top of the first page of the contract, you see the words buy-sell agreement. Sometimes it says sales agreement. Other times it's referred to as a purchase agreement. But nonetheless, what it's addressing is various scenarios where owners may choose to or be required to sell their interest in the business to other owners or back to the business itself. Now also, as I mentioned earlier, these provisions can be found in other types of agreements that have a different purpose. So partners, partners as well as general partners and limited partners often enter into an agreement that's called a partnership agreement. And it addresses a variety of different issues that partners are concerned with. Among those issues are buy-sell provisions. So within the context of a partnership agreement, you can find the buy-sell provisions that we're going to talk about here today. Likewise, in some states, stockholders agreements, the term stockholders agreement is used to identify agreement that addresses issues that are of concern to people who own an interest in a business that go beyond buy-sell provisions, but in that agreement you will find, as I said, the buy-sell provisions as well. In the case of going back to various states, different states have different statutes with regard to small or privately held business and ownership issues. In the state of Ohio, the statutes make a provision for a contract that's called a close corporation agreement. And it basically deals with shareholders' rights in small businesses. In other states, there is no such contract recognized under their law, or there's a different entity that is actually a close corporation agreement. In the case of a limited liability company, if you're the owner of interest in a limited liability company, there's an item called an operating agreement, which is a contract that members enter into that deal with the operation of the and control of the entity. And within the context of that contract, you'll also find buy-sell provisions. So there's no one single place where these provisions can be placed or exist. There's no right or wrong way to do it. It's simply an important issue to address, and any of these arrangements will facilitate that. So again, you can use any of these agreement forms. Now, when you find these agreements that were entered into early in a business relationship, the quality and the scope of the agreements come into question. In the work that I did over an extended period of time, 30 years plus working with privately held businesses, I had an opportunity to read countless agreements that had been entered into by stockholders or owners of businesses. And you find that they often were entered into in haste. Again, the 800-pound gorilla basically suggested that we ought to do something about this, but people are at that point in their career focused on building the business and addressing matters of making a profit, and they're less concerned with spending a lot of time on the content of some contract that they're going to enter into. So they kind of do it hastily. They don't spend a lot of time on this, and they often accept an attorney's draft with little examination, thought, or discussion. They just kind of read it over in a cursory way, and they accept it and sign it and run with it. And oftentimes it can be short-sighted. Now, what these contracts typically provide is one triggering provision that you'll find in all of these agreements is an item that's referred to as a first right of refusal. And what it says is that if any of the owners, the partners, wishes to dispose of his interest either by sale or gift or any other means, they first have to offer that interest to either the company itself or to other partners. So the partners of the company have the first right to purchase these shares or interests, and or they can refuse to purchase them. So if you're my partner and you want to leave the business for whatever reason, you can't sell your stock to another person. You have to offer it to me. In most instances, I'm going to purchase those interests, but if I don't, then you're free to dispose of them in whatever manner you choose. But I have the right to exercise control over that disposition of shares. The second provision that's almost universally found in these agreements is a mandatory sale provision in the event of death. And what it basically says is that if a partner is to die, the business or the other owners are obligated to purchase his interest, and the estate of the deceased partner is obligated to sell that interest. And then there's pricing issues that come up that we'll talk about later, but usually it says at the price stated in the agreement. And the agreement either states a specific price, a dollar amount, or it'll provide some methodology, a pricing formula, to arrive at the price that's used for buyout purposes. So when you read these agreements, again, that were entered into early in someone's career, what you find is that these are the issues that they've addressed. Now, on the surface, they may seem to be sufficient, but if you take it a step further, as you'll see, there are a lot of other considerations here. Before I get into those other considerations, one last point on that last slide that I want to make is legal documents. For those of you who may be attorneys or work with attorneys regularly, legal documents start out as a form or a template. And what happens, most attorneys don't sit down with a blank sheet of paper and write up a contract from A to Z. They start with a form, they fill in the blanks, they modify the content to suit their purposes, but it's, in a sense, it's a pre-printed form. So again, going back to these documents that people enter into early in their career, again, they're not necessarily well thought out, and they're certainly not customized to fit the situation for each and every business. Now, the forms the agreement take, there's three different ways you can structure these agreements. The agreement is either referred to as an entity purchase agreement, which means that in all instances when shares change hands, the business entity itself is the purchaser. So if I want to sell my interest in the business, I sell my interest back to the company itself, the business itself. The label or the title on these agreements oftentimes will say entity purchase agreement. In some instances, it's referred to as a stock redemption agreement. Stock redemption agreements are a term that applies specifically to corporations, and redemption means that you're going to sell your shares back to the corporation itself. The other type or form of agreement is called a cross-purchase agreement, and in this type of agreement, the owners exchange the shares between or among themselves. So if I wanted to sell my interest, I would sell it to my partner, not back to the business itself. And you as my partner agreed to do it. If there's multiple partners, if I have 3 other partners, I would sell 1/3 of my interest back to each of the partners. And then the third type of an agreement is what's called a wait-and-see agreement. And basically the parties agree that they're not going to decide whether to use an entity purchase or a cross-purchase until an event presents itself. And then they decide at that time whether the company should buy buy back the shares, or whether the individual stockholders should do that. That gives you, as I said, some flexibility that might be important depending upon financing options that are available at the time, who actually has the money to make the purchase, and what the tax laws might be at that time as well.
Tom?
Yes.
A quick question. With those three different options, is there one that you find that is most advisable, or is it strictly based on what the circumstances dictate?
Well, this next slide that gets into tax implications kind of addresses that issue. To answer the question, generally speaking, you would prefer a cross-purchase agreement, and the meaning that the owners exchange shares with themselves, and basically that deals with it doesn't deal with, but it addresses some tax benefits. One of the issues that comes up in a buy-sell transaction are basis considerations, which is the first point on slide 10. And basis is whatever you paid for your interest in the company. So if four of us got together and threw in $10,000 to capitalize a new business, my basis and your basis, everybody's basis would be $10,000. And if nothing else changed, when we decide to sell the business 10 years downstream, and it's worth $100,000 at that point, well then, if we sell our interest for $100,000, our basis is $10,000, and we have a gain of $90,000, and we'd have to pay capital gains tax on that $90,000. Now, in the real world, basis gets adjusted after you make your initial contribution, additional contributions of capital, depreciation on assets, and loans all come into consideration that can have an impact on what your basis is. But that gets pretty complicated for a presentation like this. But basis is important for reasons which I'll explain in just a second. Another tax implication is that whenever the company or whenever the stockholders or partners buy each other out, that's an after-tax purchase. So you have to earn money, pay taxes on it, and then use the after-tax money to purchase the interest from your partner. So because it's an after-tax purchase, it's more expensive. The payments are not deductible. Now, one of the kind of old strategies that's been used with funding buy-sell agreements is called indirect funding. And what that means is I'm going to structure the deal in two ways. I'm going to have a buy-sell agreement where I'm going to purchase the interest from my, let's say, from my departing partner who's going to retire. And then I'm going to have a separate funding mechanism like a retirement program to pay him an additional sum of money. So conceptually, or in the mind of the partners, the buyout has two pieces. Whatever I pay for the interest, or the partner's interest, and then whatever he or she gets out of the retirement program. So the combination of those two are your separation package. And in total, they're satisfactory to all parties. So when you use indirect funding, then the shares or the interest that you buy back from the partner are after-tax purchases, but the money that went into the retirement program was tax deductible. So you lower your cost at the corporate level by getting a tax deduction for funding that other program, in my example, the retirement program. That also means, however, that when the owner who's leaving sells his interest back, he or she will pay capital gains taxes on any gain, but they'll pay ordinary income taxes on whatever they receive from the retirement program. So there's a bit of a trade-off there as well. But those are tax considerations that come up. One of the things that you're trying to do is make sure that you don't break the corporation or the business financially by buying out departing stockholders. So, before tax and after tax often becomes a big consideration. Whenever you use cash or installment payments, you use a cash down payment and then installments to buy your partner out, you're going to pay him off over 5 or 10 years. There's interest associated with that because he or she didn't get their money up front. So the principal part of the payment is non-deductible, but the interest payments are deductible. So that, again, lowers your cost. When you purchase using insurance proceeds for a deceased stockholder, effectively you get a discount. The only cost for buying your partner out was whatever you paid in premium for the insurance. So if I'm insured for $100,000 and I die, my partners or the company gets $100,000 and they use it to buy my interest in the company out. Well, what did it cost them to acquire that $100,000? Well, maybe it was $10,000 in premium. So effectively, the insurance arrangement allowed them to buy me out for $10,000, the cost of the premium, or a 90% discount in that example. Also, when you use insurance, you get an increase in cost basis. So let me see if I can use a real quick, simple example to answer Chris's question about what's the more preferable one. Let's just take two stockholders or two owners. Chris and I start a business. We both put $10,000 into the company. That represents our basis. I decide that I want to leave the business and I sell my interest, which is now worth $20,000, back to Chris. Well, what happens to Chris's basis at that point? He's got $10,000 of original capital, plus he purchased my interest out for $20,000. So his basis is increased to $30,000. Whatever he originally contributed, plus what he purchased, the interest he purchased for me. If he decides shortly thereafter that he can't run the business without me and he sells out to somebody else, his gain will be the difference between the $30,000 basis he has and whatever he received from the business. Let's assume he sold it for $50,000. He'd have a $20,000 gain on which he'd have to pay capital gains taxes. Now, if we just go back and do that again, we both start the business with $10,000. I decide to sell out, but the company buys my interest in the business. So the company pays me $20,000 and buys my shares back. Well, now Chris is still sitting there. He owns the whole company by virtue of the fact that he's the only stockholder, but his basis didn't change. It's still $10,000. If he subsequently sells the business for $50,000, he's going to pay a capital gains tax on the difference between his basis, $10,000, and the $50,000 that he sold the business for. So the idea is if you're an owner and you ever have an opportunity to increase your cost basis, if you're a surviving stockholder and you acquire additional shares and raise your basis, you'll pay less capital gains tax upon a subsequent sale. If you take an example where there's life insurance proceeds, Now you might say in the first example I used, well, of course my basis increased. I paid $20,000 to Tom for his interest, so that would increase my basis. But if you change the scenario and you say, okay, let's assume that Tom dies instead of decides he wants to leave the business. So I sell I die and my estate sells the shares back to the company. Well, in that scenario, Chris's basis still is $10,000. It doesn't change any. And if he sells the business, he's still got the $40,000 capital gain. On the other hand, if the life insurance proceeds were paid to Chris, he would increase his basis to the $30,000 at what cost? Whatever the premium for the life insurance cost. So he would, for a very little cost, far less than $20,000, he would increase his basis by $20,000. So that's a bit of a windy answer, but the answer is that for those reasons, cross-purchase agreements tend to be a little more favorable because it gives surviving stockholders an opportunity to increase their basis in the company and hopefully pay lower taxes in the future when and if they decide to sell. So hopefully that was enough on that, and I will move forward to the best case scenario. With multiple owners, the best time to determine how to get out of a business is when you get into the business. That's the ideal scenario. So every day when you go in over the years, you kind of know what your exit mechanism is and you know what to expect. The best arrangement further covers all of the relevant contingencies. And what happens is that these agreements that are entered into in haste tend to neglect the relevant contingencies. I see I have a question here.
I'm not seeing it, Tom.
Okay, I'm sorry. Chairperson to all. I'm sorry, that was you. Okay.
Just sending out a request for questions.
Okay, very good. And then the third point there is that covering all of the relevant contingencies requires a commitment of time, a comprehensive discussion, and a detailed planning process. Somebody really needs to orchestrate this process with the business owners, and the business owners need to commit some time to this exercise, which means, you know, several hours and maybe multiple meetings to actually work their way through this. Short of that, if they can't make the time or choose not to, then they'll potentially end up with a short-sighted agreement. So, again, the reality is that these agreements that you find in place tend not to be, they're not comprehensive. So a better reality is one where the business owners commit the time and energy to actually, discussing this agreement in detail. So in a more comprehensive agreement, you're still going to find the basic provisions that you find in any buy-sell agreement. At a minimum, there's always going to be a first right of refusal. And that means that nobody is free to dispose of their shares and give them to any sell or give them to anybody else without first offering them either to the company or to the other shareholders or both in successive order. I first offer them to my partners. If my partners don't want to buy them, I offer them to the company. If the company decides not to buy them, then I'm free to dispose of them in whatever manner I might be able to do that. This gets into issues with regard to preemptive rights, which you find in state law and many statutes and so on. And basically what preemptive rights says is that anybody who holds an interest in an asset, including a business, has a right to acquire any additional interest that might become available before any other parties do. At the practical level, what this does is it allows you to control who your partners are. You don't find yourself in business with unwanted partners, such as your partner's spouse, for instance. You're also going to find mandatory sale at death provisions in these agreements. A lot of that has to do with tax law. Effectively, when you make the sale mandatory at death, you put the IRS in a position where they really can't challenge the value of the business. It basically sets the value, they use the word pegs the value of the business for IRS tax purposes. And then there's a pricing provision in there. Some way or another, these agreements typically don't leave the price open to negotiation. It's stated or some formula is provided to address that issue. So those provisions, again, are existent in all of them. But then you get into some practical provisions that people oftentimes don't think about, or they don't discuss, or they just comment about them in a cursory way but never get them under serious discussion. So this is where a discussion with a professional orchestrating the process comes in. Certainly a partner could become disabled. And if that's the case, then the disabled partner may find that he or she needs to exit the business for any number of reasons, including financial. Further, if you have a disabled partner who was an operator, he or she is no longer able to contribute. And if this is an extended disability, that may create problems. That wasn't the deal you made. Everybody was going to bring something to the table and contribute. So there's really no provisions under the law that require the disabilities addressed in any way, so it's voluntary. But the owners should have a conversation about disability and ask themselves whether in the event of an extended illness or long-term incapacity of a partner, that partner should be bought out or not. Now, not every agreement includes this, but it's certainly something that should be discussed. Retirement, likewise, typically when you find people who start a business, if they're close in age, their thinking might be that we'll start this business and hopefully we'll grow it to a substantial size, sell it someday, or take it public and make a lot of money. That's basically our long-term goal. Where you have owners that are of different ages. 3 people, a 55-year-old, 45-year-old, and a 35-year-old started business together. 15 years after formation of the business, the 55-year-old partner is now 70 years old. And although he may not have thought about it, he might decide he wants to retire. And without some type of arrangement in place, he goes to his partners and says, you know, why don't you guys buy me out? They may or may not do that, and they may or may not do it at a price that's good for him. And then you you find yourself in a situation where you have a partner who isn't quite as enthused about the business as he or she used to be, and they no longer contribute as much as perhaps they have before, but they're drawing the same compensation. So when someone needs to get out of the business or wants to get out of the business, it's generally a good idea to give them a way out to avoid any further disputes or put relationships at risk. Voluntary withdrawal is another way of addressing this. Anybody who chooses to leave for whatever reason when they want to leave has a way of leaving or exiting the business. You can also have involuntary withdrawal provisions built into these agreements, and that basically means that I don't want to leave, but you don't want me as your partner anymore. So I've done something or failed to do something that has caused you to want to sever the relationship, and if you choose, you can put these provisions into an agreement. There are a variety of different ways that these things can be structured. A lot of this ultimately gets to the legal aspects of these arrangements, where the lawyers put the language in that is required. But you can, to facilitate voluntary and involuntary withdrawal, you can have puts, which are rights that you give someone in a contract that says, if I have a put, that means I have a guaranteed right to sell my interest in the business whenever I choose at the price that we agreed upon in advance. A call provision says that you, my partner, have the right to call my interest in or acquire my interest even if I don't agree to it, because certain circumstances arise, or just because you simply want that right as a condition of being in business. And then there's other arrangements that are called cross-put calls, and they give everybody an option, but nobody has to exercise. So one way or the other, again, there is a mechanism in place. I see a question here. Could you briefly speak to considerations between two entities, corporations, or another one forming a third company? In other words, I think that if I understand the question correctly, what you're saying is, rather than individual people being involved in this transaction, can Corporation A and Corporation B have a similar agreement? And the answer is yes. Yeah, they can have such an agreement. It could be called a purchase agreement or a sales agreement, as we said. There would be some different implications. Corporations don't die, for instance. And but yeah, you can have an agreement, and two entities, I think, if I understand the correction, could form a third entity as well. So if that's not the answer, then ask me to clarify, or maybe we'll go live at some point and I can talk with you about it. Okay, so these are the practical provisions that you're welcome. These are the practical provisions that one would consider in an agreement. Now, other provisions that these tend to be a little bit more obscure, but they can be important. So we don't use this term so much anymore, malfeasance. If you look in a legal dictionary, you'll find it. Of course, you'll find it in the regular dictionary as well. But malfeasance would include things like a violation of trust, misconduct, inappropriate conduct, and wrongdoing in general. And it would include fraud or other crime, even a misdemeanor that might be committed by an owner, immoral or inappropriate behavior or an act. So let me give you just some examples of those things before I get to insolvency and divorce. But just things that I've run into in the marketplace over the years. A violation of trust. you and I are, well, let's not say you and I, two people are partners, and one of the partners has a relationship with the scrap dealer. So you're a metal forming company, and you have lots of scrap outside the back door, and a scrap dealer comes along and picks up the scrap and then sends you a check for that. But I have lunch, or one of the partners has lunch regularly with the scrap dealer, and he's paying him, cash under the table for some of the for some of the scrap. So one partner just takes this cash and doesn't mention it to the other partner. That's a violation of trust. Okay, anything you benefit from, and I'm not advocating taking money under the table, but in the real world, people do these things, and that's a violation of trust. It also has the implication of of a legal matter as well. Inappropriate conduct would, maybe you're disparaging your competition. Disparaging your competition can be have legal implications, and the ethics of many industries prohibits that kind of conduct. Wrongdoing, you work for some local charity or fundraising thing, and you misappropriate some funds. This is in your personal life, you didn't mean to do it, but you commingled some funds, and it gets your name in the newspaper, and it makes your company and your partner, look bad and feel awkward under those circumstances. Certainly legal charges. What if your partner was Martha Stewart, okay, and Martha got, called on the carpet for lying to federal prosecutors? Now, Martha runs her own show. She's made a great comeback. She did her time and admitted her problem. But if you were in partnership with Martha, maybe that kind of publicity and conduct might not be the basis of continuing the partnership. Certainly, immoral conduct. All we have to do is watch the news or read the newspapers, and if you're an elected official, you're probably having an extramarital affair. So you can think John Edwards and Mark Sanford, for instance, and again, that might not be good for business. So those are things that are touchy issues, but they certainly address the human condition, and a serious conversation about those kinds of things, could be a little dicey perhaps, but also could be very, very appropriate. Now, the insolvency of an owner is another issue. If your partner goes bankrupt, should you buy his interest out? And many buy-sell agreements say yes. The insolvency of your partner is a creditor issue, and it potentially places the business itself and the business's assets at risk. Now, again, it's pretty difficult for a creditor to go after the assets of the business successfully, but they'll try if there's enough money involved, and that gets you into litigation and all kinds of other legal matters. The other thing is that for bankruptcy purposes, the bankruptcy officials need to know the value of the assets of the bankrupt owner, and the buy-sell agreement provides that. So if your partner is insolvent, you get him out of the pictures to protect the company, and you will also put a price on that asset for purposes of the bankruptcy. The divorce of an owner, very, very common. Bankruptcies are common as well, but divorces are quite common, and they also represent a creditor issue. So if your partner's divorced, should you buy his or her interest out? And some agreements say yes. Why? The bankruptcy court and the attorneys representing both parties are going to need to know what the value of that asset is for property settlement purposes. And then they're also, they're going to need to know the valuation, and then the buyout prevents the former spouse from getting any access to either the ownership interest stock, for instance, of the company, or potentially any assets of the company. So those things are relatively common, and that's a tough issue. Somebody's marriage doesn't work out, and then they end up losing their interest in the business. So oftentimes, where these provisions do exist, the the owners have some other means that they discuss that allows an owner to potentially reacquire his interest, some type of right in the business somewhere downstream. And then finally, deadlock and dispute mechanisms. If for whatever reason, in a 50-50 partnership, there is no majority stockholder, so you both have to agree, then what do you do with these deadlocks? And there are a variety of different mechanisms that are built into buy-sells. Likewise, if you have 4 owners, 3 out of 4 would carry the day, but you might want to decide that you want unanimous approval for certain types of matters that may have come up in business. So dispute resolution mechanisms that have all kinds of interesting names like push-pulls and Russian roulette and all kinds of different things that come up are another consideration. Again, business owners on their own trying to build a company typically aren't thinking about these things, and the hasty agreement that I mentioned early on certainly doesn't address them. But a well-orchestrated conversation with a professional, these things will come up and they get a good discussion. Okay, pricing. The agreement also needs to, it doesn't have to, but it's certainly desirable to have some type of pricing mechanism. What is an interest in the company worth? In the hasty agreement that I've talked about before, oftentimes to save time and money, they'll just say whatever the book value of the company is, and that's basically the net worth, assets less liabilities. Any of you know anything about accounting certainly know that that is not a good number for valuation purposes. It could be coincidentally a good number, but it's more than likely nowhere close to what the value of the enterprise really is. So where you find agreements with that kind of language in it, they're really short-sighted. You can state a price, but when you do that, the agreement generally says you have to come back every year or two and restate it to either raise it or lower it based upon business conditions. And what often happens is people use a stated price and then they never revisit the agreement, or they don't do it for 10 or 20 years, and that creates problems if somebody dies or otherwise needs to sell their interest. Many agreements use a formula. They'll use something like EBIT or EBITDA, earnings before interest and taxes, or earnings before interest and taxes, and then add back depreciation and amortization, and then they multiply that by anywhere from 1 to 2 to 3 to 7 or 8 times EBITDA, and that's the formula. And again, we won't get into the wisdom of using those particular formulas in this presentation, but there is sound math and logic behind that approach. Some businesses call for an appraisal of the assets. In these businesses, they're capital intensive, and the owners feel that the assets themselves really represent the underlying value of the business, and they would choose to use third-party experts to come in and appraise the assets. And then what the agreement typically says is if the appraisal isn't satisfactory to one of the partners, then that second partner is free to go out and get a second appraisal. And if they don't agree, then they get a third appraisal, and they average them, or the third appraisal trumps the other two, or some similar language. Typically, though, in the world we live in today, more and more businesses are money-making machines. They're not necessarily capital intensive, but they generate a lot of profit and cash flow, or hopefully, that's the idea. And you value the operation of the business. And what you value, again, is the cash flow, the profit, the earnings, and so on, the EBITDA type approach, and come up with a valuation. So the agreement has this methodology built into the agreement and states that this is what you're going to use. Very often, the agreement has a default price. So if for whatever reason the primary method of valuing the business fails, there's a default pricing mechanism that's used. You very often find this where somebody says we're going to use a stated price, but if we didn't keep it up to date, the default would be book value, which again is, I think, short-sighted. It's important to keep the price up to date because business owners tend not to do this. One of the realities you find is that if if you're sitting there with owning a business with partners and you see yourself as one of the partners who's likely to be buying other people out, you're probably not anxious to jump up and say, I think this company's worth a lot more money. So what happens is people tend to hold back a little bit, and they're not anxious to increase the price as profitability increases. Then you get to a point where somebody's ready to sell out and they think the price in the agreement isn't fair, and then they're contractually obligated, to adhere to that price. And if they're really unhappy with it, they're going to break the contract. They're going to say, I'm not going to sell it to you for that price, and then you're going to get into nasty business and potentially litigation and so on and so forth. So keeping the price up to date is certainly an important consideration and one that owners tend to neglect. Payments, if there's cash available, then the agreement can say that we'll pay you cash for your interest in the business when you leave. Particularly among small businesses, cash tends to be in short supply, and buyouts often tend to be installments. So they may have a cash down payment, but then we'll pay you the balance over 10 years or 5 years or whatever the case may be. And then where there's insurance proceeds, if somebody dies or becomes disabled, I didn't mention that earlier, but if a disabled partner you can purchase insurance on the partner's disability insurance that would fund a buyout. So if you have insurance, the contract goes on to state how are these insurance proceeds going to be used. So if somebody died and you got $100,000 into the business and you said, well, we're only going to pay you $10,000 a year for 10 years, we'll keep the insurance proceeds, that's probably not in the best interest of the survivors. So the agreement typically says, to the extent that there are proceeds from insurance available, those proceeds have to be used to facilitate the buyout of the partner. Contract provisions. This is typically, where the lawyers get involved. I mean, obviously the agreement has to have the appropriate legalese. So for instance, in a mandatory purchase, the language will say something like the estate of the deceased partner shall sell and the corporation shall purchase. So why don't they say must purchase or will purchase? And the answer is that under the law, under case law and so on, the word shall is more compelling than the other two words, or at least that's my interpretation of it. So again, an experienced attorney understands these things and uses the appropriate legalese. You rely upon him or her to do that. If the terminology sometimes seems unusual to you, it's because it has a legal basis. The applicable provisions should be in there, of course, the ones that have to be in there, and those are typically the first right of refusal and mandatory purchase on death and pricing. But then all of the relevant contingencies that we discussed as well, retirement, disability, voluntary, involuntary withdrawal, and so on. And again, here you rely upon the expertise of the attorney. Funding the agreement means that you're thinking in advance, where will the money come from to buy my partners out? And sometimes businesses have cash reserves. They're good businesses. They make a lot of money, and they store up reserves. These reserves might have no particular purpose. They're just there for contingencies. One of the contingencies, again, might be to buy a partner out. In other cases, businesses create a sinking fund, a savings account. Every year or periodically, they make deposits to this savings account to create a fund to buy stockholders out. Now, in profitable businesses, those things are possible. In marginal businesses, it's much more difficult. Some businesses have very strong cash flow, and they could absorb a buyout, so they'll rely upon that. In other cases, they may decide to sell assets, of the business, and they'll sell off equipment or whatever, or inventory to finance a payout. They could use third-party financing, but bankers and other lenders are typically not anxious to lend businesses money to buy out stockholders. That's not a productive asset. It's not a productive transaction. You don't make any money doing this, and bankers tend not to like those transactions. And then as it relates to death or disability, of course, life insurance is very often purchased to deal with the death of an owner, life insurance is relatively inexpensive. In fact, term insurance is dirt cheap, so it makes a lot of sense to use life insurance in funding these agreements. Disability insurance, on the other hand, is a little bit more expensive, but nonetheless, where those circumstances arise, it does become very valuable. One other thing I didn't mention in the slide that you could use your partner's compensation. If I'm making $100,000 a year as your partner, and you're making 100, and I decide that for whatever reason I want to go out west and become a cowboy before I get too much older, so I want to leave the business. Well, if I'm no longer there and you don't need to replace me at $100,000, then you've got some money, hopefully, that can be used to buy me out. Yeah, I'm going to have to move along here pretty quickly here. I've got just a few more slides. So the idea of this agreement is to provide protection. You're protecting the business itself and its assets and its reputation from your partners and their conduct. You're protecting the owners from one another, and you're protecting the owners from third parties like angry former spouses and creditors and so on. Also, with regard, there's oftentimes a need or a desire for people to exit the business. Their health may change. They grow older and no longer have the energy or desire that they had to run the business. Their circumstances can change. They have other opportunities they'd like to pursue. There's personal or family problems, loss of interest, out of touch. They're not in a changing world. They just don't get it anymore. Or, the old blood doesn't have any new ideas, and maybe it's time to go. Discord in the business. Occasionally, you're going to find irreconcilable differences that exist among owners that have to be resolved in some fashion. People all of a sudden don't like each other anymore or one another anymore. Their objectives are conflicting. One guy wants to go left, the other one wants to go right. Somebody wants to sell, the other one doesn't, and so on and so forth. Personality conflicts can arise, and then outside influences. A second marriage of your partner, for instance, creates new dynamics and so on. So all of these things, again, are addressed. The general benefits of having a buy-sell agreement are that you control the ownership of the business. You don't end up with unwanted partners. You avoid negotiating from a position of weakness. I'm sick or disabled. I need you to buy me out. And, what kind of a price am I going to get under those circumstances? I know what to expect on a day-to-day basis. We know the terms and the provisions of the arrangement, so there's no surprises. Each partner knows the value of his equity in the company, and the business knows the cost of the buyout. So it's a win-win scenario. You and your family walk away with your money, hopefully a fair price with no ill will or animosity toward the former partners, no unexpected or unpleasant surprises. You avoid difficult negotiations. You avoid being taken advantage of. You avoid expensive and painful litigation. And you achieve a fair and equitable outcome. You do not put a financial strain on the business, create and maintain goodwill and a good reputation for the business and the owners, and then the business in the long run survives and continues to prosper. So that's what you get, when you have, a well thought out agreement. It's not a perfect world. The best laid plans of mice and men don't always work out, but this takes you a lot further in the process than you would otherwise be, either without an agreement or with that agreement that is entered into in haste. And that concludes my comments.
Tom, I have a quick question.
Okay.
You mentioned at the very beginning of your presentation that a lot of times business owners don't like to spend the time to focus and really look at the buy-sell agreement and these agreements to really make them worth, a good functional agreement for them. Asking as someone who often talks to business owners and has to convince them to do this kind of stuff, what do you say to get them to really take the time and go through and make sure that their agreements have all the provisions that you recommend here?
War stories.
Okay.
Tell them horrible stories, about, hopefully they're real stories, about experiences that you've been involved in or you've observed with your clients, and they'll relate to that real quickly.
Okay.
I told a story at a trade show not too long ago about a guy who was making all kinds of money in a business, was filthy rich. In 18 months, competitors came into the market, big companies like Walmart types, and drove them out of business into the brink of bankruptcy in 18 months. Now, that was in a conversation about some type of an agreement. They related to that story in an instant. They said, "Oh my God, I wouldn't want that to happen to me."
Right.
So, how do you deal with that kind of thing? And so, war stories are the way you get people to do these things.
Okay. Thank you. I think real quickly what I'm going to do is I'm going to open up the phone lines here in a second and ask anybody if they have any questions that they want to ask Tom. So just be aware that the phone lines are going to be opening, and any noise that's going on in your personal office might get transmitted across the internet here. Okay, here we go.
The conference has been unmuted.
Okay, do we have any questions out there for Tom that anyone would like to ask?
I have one. In your experience, have you ever seen buy-sell agreements funded with whole life insurance products that not only would cover the contingency of a death, but also, the net cash value of that being used to fund someone leaving, and what are the advantages or disadvantages of that?
Yes, I've seen that. It's relatively common, to use whole life insurance and look at the cash value as a reserve or a sinking fund. Some of the advantages of it are that the fund itself is a tax-sheltered vehicle, so any increases in value are not taxable. Depending upon how you pay money out of the insurance contract, again, you can pay out principal first, as opposed to and not have to pay taxes on distributions. Of course, the death benefits are income tax-free if somebody were to die. So it's quite often used, and has lots of advantages that are very desirable. The downside to using it would simply be that it's a little bit more expensive, obviously, than the other term insurance, but nonetheless, if the company has the money, it would probably be a suitable vehicle.
Thank you.
You're welcome.
Tom?
Yes.
Can buy-sell agreements ever be used to promote the employee ownership plans?
Yeah, that was in my notes here. I have a comment on that I didn't make. Well, in terms of financing the buyout of a partner, one of the things that you could do is you could form an ESOP. And the partner could sell his or her interest to the ESOP if you're open to the idea of employee ownership. And many businesses might be. And in a scenario where we have, let's say, 4 partners, ultimately 1 or 2 of them are going to be left standing. And then what happens when they exit the business, either voluntarily or if they die? And an ESOP could be used as a financing mechanism and a succession mechanism as well.
Thank you, Tom.
You're welcome. Another scenario is to bring in new owners. I sell my shares and you bring in a new partner. Maybe the new partner buys my interest in the business, and that's where the financing comes from. That's not often done, but you'll see it occasionally.
All right, any other questions? Okay, great.
I must have stunned him. Okay.
Oh, that's good. I thought it was an excellent presentation. Well done. Thanks, Tom.
Okay, you're quite welcome.
I want to, again, encourage folks who, Tom is one of the better ones in the business, so I encourage you to get a hold of him. His contact information is up on the screen in front of you. If you have any additional questions or want to talk to him further.
If I may, Chris, I meant to put my email address on that last slide, which I didn't do.
Okay.
But real quickly, my email address is Tom, T-O-M, Gilbride, Gilbride, @gilbridece.com. So if anybody has a follow-up question, tom.gilbride@gilbridece.com, I'd be happy to answer it for you.
Great, super, thank you.
You're welcome.
I'll let everyone know that, as I mentioned, we will be posting up his slides in a PDF form up on the website with the recording. Maybe later today or first thing tomorrow morning. so look for that as well. We have an additional webinar coming up this Thursday. Jay Simachek from our office here at the Ohio Employee Ownership Center at Kent State University is going to be presenting on a session on maximizing the ESOP benefit. So there was a couple questions here about ESOPs today. So some of the questions about how you maximize the employee ownership benefit, Jay's going to be going over that. And so I want to thank you, everyone, for coming. And if you have any further questions for me, you can get a hold of me. My information is up on our website where you went to register for this session. It's oeockent.org is the website address. And with that, I think thanks again, Tom, and we'll let everyone go.
Thank you. You're welcome.
All right.
Thanks, Greg.
Thanks.
Chris?
Thank you. Please stand by.